Okay, so we're going to be going through the Chapter 8 video example, and I've got a problem from Chapter 8 that I'm planning on working through. So this is problem 827. Your homework is problem 826 and 30, and this is very similar. It's a 4-variance overhead analysis. This is the Lopez Company. They use standard costing, as we've been doing the last couple of chapters. And when you have a standard costing system, you also have a variance. And we've looked at direct material variance, we've looked at direct labor variance, and now we're going to talk about variable manufacturing overhead and fixed manufacturing overhead variances. And if you remember, every product has these costs in it. And a standard costing system tells us how much one unit would cost to. So they give us information in this, and they tell us that a standard cost of a particular auto part based on a denominator level of 4,000 outputs per year. So we're making an auto part, 4,000 per year. Includes 6 machine hours, a variable manufacturing overhead. And so the driver, what's driving it up is machine hours, and there's 6 for variable. And then they tell us that there are 6 for fixed, and they give us a rate for variable of $8 per hour, and for fixed it's $15 per hour. Then they tell us that we actually produced was 4,400 units. So we budgeted 4,000, but we produced 4,400. And then they tell you that actual variable overhead is $245,000, and that actual fixed overhead is $373,000. So, and I just graded your last quiz where we talk about the overhead rate, and I don't think some of you have a really good handle on that yet. So hopefully it's starting to click a little bit. We may go back and review that quiz and do some more work on that later. But basically what we're saying here is that for every machine hour, every 6 machine hours, we make 1 unit. And for every hour we work on that machine, we apply $8 of our variable overhead and $15 of our fixed overhead. So we estimated our overhead for variable and for fixed. And then we have our actual. So we've applied it up here, but we have our actual. So we're going to have some variances. And then they then they tell us the actual machine hours, because that's also an estimate. Actual machine hours were 28,400. Then they ask us to prepare an analysis of all variable manufacturing overhead and fixed manufacturing overhead using the 4-variance analysis in Exhibit 8.4, which is page 304 in your book. And the way that we do that is we have to calculate a few things. We have to figure out what our budget for fixed manufacturing overhead is. And the way that we do that is we look up here and we say, okay, we thought we were going to make 4,000 units. We thought it would take 6 machine hours to make 1 unit, so that's 24,000 machine hours, and we're going to apply $15 per machine hour. So with that in mind, it should be 4,000 units is what we thought we would make. We thought it would take 6 machine hours for each one, and we thought we would apply $15 per machine hour. So that being said, we budgeted our fixed manufacturing overhead to be $363,000. That's at the beginning of the year what we thought our fixed manufacturing overhead would be. It was actually $373,000. So we have a variance of $13,000. It's unfavorable. Actual was more than budgeted, but we're going to break that down and learn a little bit more about that number. So on the 4-variance analysis, we have our variable manufacturing overhead, and this should look exactly like what you have in your book, so you can look at a few other examples. We have fixed manufacturing overhead. And then from there we calculate Let me add a line here. Our spending variance, we calculate our efficiency variance, and we calculate our production volume variance. And from this, we'll get 4 variances. I know there's only 3 columns, but again, look at that example in the book and you should be able to see what they mean by the 4 variants. So there's never a variance on efficiency for fixed manufacturing overhead. And there's never a variance on variable manufacturing overhead. For production volume variance. So what we have left is 1, 2, 3, 4. That's what we mean by the 4 variance analysis. Okay, so now to kind of do the work that goes behind this, we're going to do variable manufacturing overhead first. And again, this is just almost identical to what you've got in your book and what you'll be doing in your homework. So hopefully this will be a good example for you. You have your actual cost incurred. We're going to have 4 across here. And then we have our actual input times our budgeted rate. And then we have our flexible budget input allowed for actual output. The terminology is a little more explicit in this chapter, times the budgeted rate. And I'll go fix the formatting in this in just a minute. And then we have the allocated. When we talk about allocating overhead, that's what we're talking about there. Budgeted input allowed for actual output times the budgeted rate. Okay, it's a lot of words. Don't let it overwhelm you. It is very self-explanatory, almost more so than the other chapters we've used. Flexible budget input allowed for actual output times budgeted rate. And it's just read it. There's no secret terminology there. And so our actual variable overhead was given to us, and it was $245,000. Our actual input times our budgeted rate. Okay, so we go back and we see what was our variable based on. It was based on machine hours. And then we want to look at what was our machine hours. Our machine hours, so our actual input machine hours was 28,400, and our budgeted rate was $8. That was given to us. Those dollar signs always throw my formulas off. Okay. And then I'll just go ahead and calculate all these. Okay, then we have flexible budget input. Now remember, flexible budget says we're going to use our budgeted rates, but we're going to base it on how many units we actually produced. And so we look at how many units we actually produced, and we see that it was 4,400. So 4,400 units allowed for actual output. So this is where the flexible part comes in. Flexible, the only thing we're changing here is the actual units. It's still $8 an hour. Okay? And then on the allocated, it's basically the same thing. That's why I was saying earlier there's never a variance. But where it's different, you'll see in just a minute, is the overall variance. Okay, so then the variance between these two, I realize I can do it this way, is the difference in these two numbers is 17,800. And our actual was more than our budget, so this is unfavorable. Again, doesn't necessarily mean it's bad, it's unfavorable. And I'm going to come down here and take the difference between these two numbers, 227,200 and 211,200, and that's my $16,000 is that variance. And that is unfavorable as well because our actual is more than our flexible budget. Okay. And then these two together, and again, look back at the example in your book. You've got several examples of this. 33,800. We're netting the two. They're both unfavorable, so we add them together. And then all the way across will also be 33,800 unfavorable. Okay, so basically all we've done is just set up a 4-variance analysis to figure out, we have overall 33,800. What caused it? Well, we look at this 16,000. That is called our efficiency variance, so that's how efficient we were. And this one is called our spending variance. And so this one is caused by a change in the overhead amount, and this one is caused by a change in the overhead driver, which was machine hours. So we come over here and we see that our spending variance was 17,800, unfavorable. Our efficiency variance is 16,000, unfavorable. Never a variance here. And now we're going to do the same thing for our fixed manufacturing overhead. Okay, so for our fixed manufacturing overhead, we're also going to do a 4-variance analysis. And I'm not going to make you watch me type all of this in. Okay, so I filled in, and you can pause and go in and look at all that, but you've got the work in front of you, so I just went ahead and typed all that in. So my actual cost incurred for fixed was $373. That was given to me. My same budgeted lump sum, regardless of the output level, is the budgeted amount times the budgeted hours times the budgeted rate. 360,000. The flexible budget, remember flexible budget, same budget and lump sum as in static budget, regardless of the output level. This is the same number, and you're going to see how this all works together when we get done, but it's the same number. And then this one is based on actual output, which is 4,400 times the budgeted rate. So this is where we say there's never a variance. It's these two numbers right here. There's never a variance there. So we'll find this variance, which is 13,000. And that is unfavorable because our actual was more than our budgeted. And there's not a variance here, and so we've got a variance over here, and the variance over here is $36,000. And that is favorable. All right, and then the two together, you net them, and so it would be 23,000 favorable. And then this is how we complete our analysis. This is 13,000 unfavorable, and this is 36,000 favorable. Okay, and then we move on to part 2 of this problem.